Hello and welcome. This is Barry Page with the Legacy Insurance Agency. Continuing with our three-part video training on the infinite banking concept, how to become your own banker, explained and simplified. Video 2, how does infinite banking work? This training is based on the best-selling book from Nash, Becoming Your Own Banker. I'm pictured here with Nelson at the Infinite Banking Concept think tank in Birmingham, Alabama. I'm a registered financial consultant and a licensed insurance agent. I'm also an Infinite Banking Concepts authorized practitioner. I've been practicing infinite banking in my personal life for over 10 years. So how does infinite banking work? It works through a custom designed, dividend-paying, participating whole life insurance policy from a mutual life insurance company. These policies are slightly different, primarily because we tend to work with mutual companies that pay dividends. A dividend-paying whole life insurance policy works slightly different than probably the policies you might be accustomed to. Now, just with any life insurance policy, actuaries design and build policies just as engineers design and build machines. They work with mortality tables that are based on actuarial data from 10 million selected lives. Lives are selected based on even more data from underwriting statistics. In other words, lives that have been underwritten. Data is then used to calculate annual dividends based on the company's current mortality experience and their operating expenses. Dividends are not guaranteed. However, they have been paid consistently for well over 100 years by most mutual companies, and it is their goal, the insurance company, to pay a dividend every year. Dividends have actually increased due to significant increases in longevity in recent years. A traditional whole life policy has guarantees. First of all, the death benefit is guaranteed. It's guaranteed to never go away or decrease as long as the premiums are paid and the policy is in force. It's guaranteed to have a level premium, meaning that the premium is not going to increase over time because of mortality expenses. The premium is level. The cash values are guaranteed. They're guaranteed to increase over time. The non-guarantees are really only the future annual dividends. After dividends are paid, they are guaranteed in the cash value. Only future dividends are non-guaranteed. Dividends allow the policy's cash value and death benefit to grow. The longer a policy is in force, the more guarantees it provides. Future dividends cannot be guaranteed because a company cannot predict the future. Guarantees are based on the claim-paying abilities of the company. So how does the IBC design policy work any different than a traditional whole life policy? IBC stands for Infinite Banking Concept, and IBC policies are designed to accentuate cash value growth, especially in the early policy years. So the emphasis is taken off of the death benefit and placed on the cash value. So you have access to the capital. Traditionally, life insurance policies do not pay a dividend for the first couple of years due to the additional expenses incurred when a policy is created. Things like administrative costs, underwriting, so on and so forth. But once a policy has been in force for a few years, it starts to grow more rapidly due to the dividends being paid. Dividends are excesses or surpluses of capital. And because this is considered a return of premium, it is not considered a taxable event according to IRS rules. Policies have guaranteed growth even without dividends. And when dividends are paid, the policy owner has the option of having them reinvested back into the policy as paid up additional insurance. This additional insurance has little to no expense because there are less costs of acquisition, sales commissions, etc. So let's take a look at a sample IBC designed policy illustration. Now, if you look to the far left top here, this is based on a male age 38 when the policy was issued with a preferred rating. And he's chosen to have the dividend go to the paid up additions. And he's also chosen a number of riders. The waiver of premium rider basically provides a disability benefit should the policy owner, the insured, become disabled. The policy's premiums will continue to be paid. There's also an LPUA, a level paid up additions rider on this policy for 5 years, and an accelerated benefit rider. So this works somewhat like a long-term care, or if the person became critically ill, he could access the policy's death benefit or a portion of it. Now, top right here, the initial premium paid into this policy was $40,000. And that bought an initial face amount or death benefit of $949,811. Now, this was just what the policy owner decided to purchase. There are no limits as to, or guidelines as far as to what you can purchase. The policy owner can determine that based on, the death benefit and also how much premium deposits he wants to make into the policy. Okay. So in this case, the base premium, if you look down here to year 6, was $19,340. So that additional money, the $20,660 to make up to the $40,000, was going into PUA or paid up additions, as we discussed in an earlier slide. So if you look here, after the first year, there's a guaranteed cash value with this policy of $20,357. Okay, and the left column's guaranteed. Now, the non-guaranteed columns are assuming that a dividend was paid based on the current dividend. Okay, now in today's environment, we're in a low interest rate environment. So the dividends that are being paid now are probably much lower than they have been in the past. And so we can only assume or hope they're going to go up in the future. But this is only based on the current dividend scale. Okay. And again, this company and most of the mutual carriers have been paying a dividend for well over 100 years. But this dividend is based on the current scale, which is, again, some of the lowest that it's been in history. So with this policy, the first year, age 39, after the first year, paying $40,000 in premium, there was a guaranteed death benefit of $33,841. Over here in the non-guaranteed assumptions column, the death benefit was $1,042,652, and the cash value was $22,466. So it was actually higher, as you see here, because of that annual dividend being paid of $2,108. Now, again, when this was first issued and this illustration was made, the policy had not been put in force, but this was an actual policy, and it has been put in force, and the cash value and the death benefit have kept up with these columns just fine. So if you look on down here, the premiums were paid for 5 years. Back over here to the far left, contract premium paid for 5 years at $40,000. Now, if you notice in year 6, the premium decreased because the policy owner elected to not pay that paid up additional rider any longer. So now that money can be used for a number of other reasons, to start another policy or for lots of other things. But this policy has been kickstarted, as we like to say, in the early years to help this cash value grow quicker. Normally, there would not be any cash value over here for about the first 2 or 3, usually the 4th year before that cash value starts to build, or a dividend, in this case, this column here, is paid. Okay, so in year 5, $200,000 have been paid into the policy, and there's $180,960 available in cash value. The death benefit is increased to $1,432,879. This cash value is available at any time for any reason to the policy owner. The death benefit has increased substantially, as you see from the initial face amount, or death benefit. Let's go on down to year 10. So now in year 6 through 10, only $19,340 was paid as premium. And if you look across over here, we like to look at these columns. And the net cash value is $329,000, with the death benefit now at $1.6 million. So the policy has grown pretty substantially, and as you see here, even though $19,340 was paid in premium, the increase in cash value, this column here, was $33,571. So looking on down to the bottom of this page in this illustration, age 53, year 15 of the policy, $19,340 went in the policy again. That policy, as you see, that number has not changed. That policy premium is level. And the increase in cash value that year was $45,969. So that increase in cash value has grown every year. The annual dividend has grown every year. The cash value has grown every year. The death benefit has grown every year. So at this point, 15 years into the policy owner is age 53 now, and the death benefit is nearly double what it started out to be. The $949,000 has now grown to $1,827,219. Pretty substantial. And the cash value is now over $500,000 at $534,295. Okay, so as you can see, that's pretty impressive. Now let's move on over to further on in the policy. If you look here at year 20, policy owner is age 58. There's now $803,000 in cash value, and the policy increased $59,153 that year. The annual dividend was declared at $25,397. So again, even let's just say in year 25, if there were no dividend declared, this cash value is guaranteed here to not lose value, this $803,000. So, but in this case, the dividend was declared, and the policy continued to grow. Now, if you look here, in year 38 of the policy owner is now age 76. There's a guaranteed death benefit of $1.3 million and guaranteed cash value of $948,000. But this policy owner is not paying any more premiums because the way this policy was set up, it was contractually paid up after 35 years, okay? So no more premiums are due. And the reason this jumps here is in these latter policy years, the way these illustrations are set up, they jump, 3 years at a time and then, 5 years, okay? But regardless, no more premiums are due after that 35th year. The way this policy was set up, there's literally infinite ways to build a policy. This policy was built for this particular individual. So at this point, no more premiums were paid this year, yet the policy, if you notice, there was a dividend declared of $79,000. And the increase in cash value for the policy was $128,987. That's pretty substantial. The cash value now is $2,499,370, and the death benefit has grown to $3,536,227. So the policy is rocking along pretty good. Now, if we fast forward on out, should this individual live to be 98 years old, year 60 of the policy cash value is now $7.2 million, which he could take the money and run if he wanted. He could surrender the policy. He could take a loan on the policy. But the death benefit now is close to $8 million, $7,943,305. If he died, his family would receive that death benefit, or his beneficiaries would receive that death benefit. Anywhere along here, the policy owner, his beneficiaries would receive the death benefit minus any outstanding loans. If there were no outstanding loans, they would get this entire amount. At any time during the policy owner can take a loan against the policy or surrender the cash value of the policy. So let's take a look at a chart, a little different way of looking at things. And you've probably heard me say before that banking is a process. Banking is not a product. So forget about the life insurance for just a minute and realize that this is a process, just like a traditional bank has a process. They make loans and people repay loans. So do life insurance companies. Life insurance companies work very similar to banks in the sense that they make loans and policy owners or others repay the loans. So just follow with me. This chart is from page 26 of the 5th edition of Becoming Your Own Banker. It is copyright by the Infinite Banking Concept, and it's registered in the United States Patent and Trademark Office. So as you see here, premiums, the arrow is pointing in to this money pool. The money pool is managed by the life insurance company. The policy owners, through a mutual company, own the company. All right. So premiums go into the money pool. Now, the company makes loans first to the policy owners that want to take loans. All right. So the policy owner has full access to the cash value at any time for any reason. But the insurance carriers also take any monies out of the money pool that has not been loaned to policy owners, and they put that money to work in the form of mortgages and loans to joint ventures. Now, these aren't your everyday mortgages that you think about for homeowners, traditional mortgages, subprime mortgages. These are secure mortgages typically made to large banks and financial institutions or businesses, for instance, credit and financial companies that turn around and loan the money out themselves. So joint ventures, these big developments, these are ways that the company loans the money out. And as you see, when they make loans, their repayments are made back into the money pool. And interest is paid on the loans, just like with a bank. But in the case of the policy owner here, this interest is paid back to the money pool, which allows the carrier, the company, to pay a dividend, as we discussed earlier. The dividends are based on the surplus of capital, the money that has been put to work after all of the expenses are paid. So expenses of operation, and every so often a death claim will have to be paid. And what's left over is the dividend. So again, banking is a process. It's not about the product, the life insurance product. It's a process. So how do IBC design policies differ than other policies? I'm just going to recap what we've already discussed. The death benefit increases over time, and it's guaranteed not to lose value as long as premiums are paid as scheduled. Cash values increase over time and are guaranteed not to lose value as long as premiums are paid as scheduled. The savings benefits are improved, and they include liquidity, use, and control. Dividends have multiple uses. They can be used, taken as cash. They can be used for many reasons, but most often they're used to reinvest into paid up additional insurance so the policy actually grows quicker. With IBC design policies, your pension, your IRA can be maximized so you receive more income from these other assets. And that's a whole nother training, but just understand that when utilized correctly, policy can actually make your other assets stronger or better. Tax benefits are increased. Liability protection can be improved. In most states, life insurance is creditor protected. Disability protection can be improved with a waiver of premium rider. Long-term care benefits can be improved with a long-term care rider. Legacy and estate planning are enhanced and simplified using life insurance. So, these policies function like a bank by you making deposits and loans, by giving you access to capital, allowing you use and control of your money. One thing that I haven't really discussed, but I just want you to grasp here, is that this money continues to grow even when there's a loan against a policy. There's uninterrupted compounding of the money. So that's the big difference why you might want to take a loan from a policy versus paying cash or loaning from another financial institution. So here's the rules of infinite banking. The first rule is you have to think long range. This doesn't happen overnight. It's not a get rich quick. This is something that you have to think about and plan over time. You have to capitalize your system. You have to make deposits to your bank per se. You have to pay the premiums. You have to borrow and repay from and to your system. In other words, you make a loan and you repay the loan. You become an honest banker. And you have to discipline yourself to repeat the process if you want to practice banking. Now, a life insurance policy will do fine just on its own. But if you're going to be borrowing money, if you're going to be spending money anyway, why not utilize your policy and pay interest and repay your loans back to your policy, to the insurance carrier, so you can earn dividends. Teach your family and others. If you learn infinite banking, we feel it's our obligation to share this with others, because they're not going to learn this through traditional financial planning. They're not going to learn it from their accountant, and they're certainly not going to learn it from their banker. Infinite banking is the solution to having your money work harder. You can get multiple uses of your money, protect your family and business, finance your purchases, grow your wealth, and leave a legacy. And starting your bank is as simple as 1, 2, 3. The first step is you have to take action by scheduling a meeting, either with myself or with another infinite banking concept practitioner. You have to capitalize your financial system, i.e. your bank. You have to put money into this system. You have to build the capital pool. And then you have to practice the infinite banking concept in order for it to work. The policy will grow on its own, again, like I mentioned, but if you practice infinite banking, your policy can actually grow even faster. And the main thing is get you out of the traditional banking loop where you're paying interest and fees to others. So, after watching these videos, you're one of 3 people. You're either ready to take action and get started, you need more information, or you want to keep on doing what you're doing. Any of these are fine. It's really up to you. If you're ready to get started, the way to get started is to quit talking and begin doing. That's a quote from Walt Disney, who used his life insurance policy to borrow money to start Disneyland. So take action, begin doing. To get started, just request a personal review. You can go to my website, legacyinsuranceagency.com/IBC. Again, that's legacyinsuranceagency.com/IBC. If you need more information, keep learning. Read the book. Reread the book if you've already read it. You can get Becoming Your Own Banker, Unlock the Infinite Banking Concept at legacyinsuranceagency.com. Thank you for your time. Watch for more of our videos and share them with your friends and family, please. Our YouTube channel is youtube.com/legacymoney. And like and follow us on social media. We're on Pinterest, YouTube, G+, LinkedIn, Twitter, and Facebook. So thank you for your time. Please subscribe to our YouTube channel and follow us on social media, and I'll see you in the next video.